All right. Happy Thursday, everybody. This is RJ with Cashflow Real Estate and Money, the cream, and excited to have Brad, Heather, Scott, and Ashley on today's live stream. A lot of you guys have been asking this question was how do you underwrite a multifamily deal? And some of you guys that are watching this, some of it could be you are already underwriting multifamily deals, and probably have done many multifamily deals, and that's amazing. Most of our audience has been heavily in the residential world, and so this might be new. This might be something that you've already done, but just like always, you still got to practice. There might be an aha in this underwriting session that we're going to do, and I'm excited to get into this because this is a deal that's actually in my backyard that was sent by Brad, and Brad and his team are on here from Midwest Acquisitions. And this is basically what they do all day is look for multifamily deals all over Ohio. And this one just happened to be in our backyard in Columbus. I'm in Columbus. Brad and his team are in Dayton, right? Are in Dayton area. Are
Correct.
anybody on the team virtual?
No.
Okay, so we got Scott. Scott, where are you from? Like,
I
where are
am
you
in
at?
I am in Antioch, Illinois, so I'm sitting comfortably on the border of Illinois and Wisconsin, way up north.
Awesome.
Yeah.
Awesome. Cool. So you're out there. You're still I was a pretty good market. Never been in there.
Can you hit that?
They have quad cities there, I heard, right? That that seem to be pretty decent for from a residential standpoint. But and then Ashley, are you in Ohio? Are you
Yes, I'm in Springfield, Ohio.
Oh, cool. Awesome. All right. We so glad to have you guys on. And Acquisitions, this is what they do all day. Is they look for multifamily deals. And I know Brad and I go back to a mastermind that we're a part of, Collective Genius. And then Brad also got involved with some of our deals here in Ohio, and quickly learned that Brad has a very strong grasp on underwriting multifamily deals, how to structure deals, even structure deals creatively. So we're going to get right into this deal. If you have questions, you can certainly put them into chat. But I want to make sure that we get a lot of the content out of this into this live stream because some of you guys are going to be watching this later in YouTube and anything like that. So I also want to make sure that you're able to connect with Brad and his team. So we're going to have a lot of a Q&A here at the end. So hopefully we'll get through this. Probably going to be a half hour, 45 minutes. But if we get a lot of engagement and you get a lot of questions, then we might go on a little bit longer. But we want to be super respectful to Brad and his team. And so we are going to get right into it. So I am opening up the share screen here. And I want to make sure you guys can see this. So if you guys see this, just type in the chat now. If you can see it, just type in a Y or yes that you can see this. But let's go ahead and take a look at this deal here. Scott, do you want to
Yeah,
take the lead here?
absolutely. I'll dive right in. So, one thing to know about multifamily, and if you've been in multifamily, you probably know this. If you haven't, it's important to understand deals will come to you looking many different ways in many different formats, presented many different people keep their books different way, they package their deals different way. So part of what we do here is kind of deciphering the language that the package has been put into and having to kind of decode it and put it into not only the language we want to see it in, but the language that the bank wants to see it in. So this
Gotcha.
so this particular deal came to us in this format, which is a pretty typical pitch deck, corporate lease condo portfolio near Children's Hospital in Columbus, sales price at 2.7. They give you a little summary of the area and property being occupied. But what we really want to look at is the financials. So I'll go through this whole thing just so you can see it. It's not very long. They include some exterior pictures. They give you some aerial photos. They give you some maps. They give you the broker bio. But essentially, all you're really getting here is this, which is what we need: the meat and potatoes, the financials.
Gotcha. So this is like the most important part.
Absolutely.
Yeah. Okay.
So the pictures, the area, all that stuff kind of fills in the narrative of, okay, what's, it fills in the color of the story, but this is the black and white. This is the shell. This is the hard nose, nuts and bolts. Can this work? Is this good for us?
Gotcha.
And obviously questions fuel conversation. So if any questions are in the chat, or RJ or anybody has anything to jump in, just shoot from the hip and fire away.
Yeah, I will be moderating that, and I'll let you know, Scott. But this is what Scott's saying is that this is the most important thing to get from either a broker or a seller that's off market that isn't being represented. This is super important. So
So specifically, what we want to get is a T12 and a rent roll, a trailing 12-month of financial histories, and a rent roll showing current vacancy levels, what's rented. So on the left here, you'll see the rent roll of the units they have rented. On the right, you'll see a very, very simple P&L where they just have it broken down strictly to rental income. They have expenses very, very simply broken down. And it comes flat out to an NOI. So in different scenarios, you'll see different property managers and different property owners who've been managing their books in different ways. This one is really clean and put together for us so that there's not a lot here to really look at and underwrite. So we can kind of jump right down to the NOI. And off the top, Brad, I'll let you jump in here. But the only thing I might look at changing is this vacancy number. Everything else looks really straightforward and really to the point, and I don't see much here that we would have to.
So one of the red flags I see right off the top is, under expenses. This is what I'm always looking for. Is under expenses. They're saying their expenses for the year are $43,000, and they're bringing in $215,000, right? So I quickly do a calculation and determine, what percentage, what is their OPEX?
Yeah.
What's a realistic OPEX for this particular area? They're saying this thing is operating at 20%,
20%.
right? So their expenses compared to their income is 20%, which to me is a huge red flag, right? It's really probably unrealistic. They also don't have, they do have management in here, but with managing there and running at a 20% OPEX, that's a red flag to us, right? We're looking for something a little more realistic in the 35 to 40% range for a really tightly run property.
Gotcha. So 20% is like that ain't happening. That's
a red flag to banks as well.
Right. You might get into a situation where you send this to underwriting to a bank and they red flag it and they say, hey, hold on, 20% on a multifamily deal in this particular area is way below average. We're going to hit you with the average for the area, and you get screwed on your cash out or your purchasing power because they went ahead and used the average for the area versus what you said it was, right? So good point, Heather. That's huge.
So Brad, would the strategy here then be to dig into the expenses and try to get things like utility bills, things that verify expenses? What would, looking at this and seeing that it seems too good to be true, what would the thought process be like?
Absolutely. So that's the first step, is really underwriting it with the numbers that they have, which is, everything that we do here on a daily basis, right? We're going to plug in the numbers, see what the numbers look like. If the numbers look good, then we go to phase 2, which is digging into the actual expenses. That may come after we have it under contract and we're in the due diligence phase. But first and foremost, we want to see if this deal even meets our threshold with the numbers that they give us. Right. So that's kind of the first step. Then in due diligence, we're going to ask for actual bills. We're going to ask for actual leases. We're going to go on site. We're going to visit the property. We're going to make sure that what they say as far as maintenance looks correct, right? These things have just been remodeled. Is there really zero deferred maintenance? Has everything been fixed to such a high standard that they have no maintenance, right? So these are the things we're going to be looking for.
And you're saying even on a property that's newly renovated, like this seems to be, 20% is a red flag. Like even if it's newly renovated, everything's new, we're still looking at a 35 to 40% operational expenses, or OpEx, what you guys calling it, right? So is that pretty accurate, Brad?
Correct. I
The
think
lower end.
20% is going to be, a perfect world scenario.
Perfect
Right?
world.
I would say a non-renovated unit should be hitting 50%. If
Mhm.
you're completely renovated, you're going to be somewhere in the 35 range. I mean, if you think about it, look at management right off the top. They say that's 10%, right? Or 8%. They have 10% on this list. 10%, right? Management fees. Water, we know water to be at least, 7 to 10% usually on in the Midwest. Right. So
Mhm.
right there, you're at 20% without any other, you're not even talking insurance or property taxes. Right. So I think 20% is definitely a red flag.
And I'm looking at this, if I'm looking at this correctly, the vacancy they're saying is 2%. And that's not realistic either. Is that what you guys are seeing, 2% for vacancy, or is that 3?
Yeah, I think that's I think
It looks
that's
like it's 2.
3.
Is
Is
it
it 2?
3?
I believe it's a 3.
It's hard to
So
see on this screen, but
3.
even that is like,
yeah.
I don't think that's realistic either.
What
You
I
know?
see a lot of guys that are trying to sell their properties right now, they're bringing you um, deals that they would call underwritten with the income at the very top threshold at 100%, and then they're removing the vacancy. I see a lot of people doing this. I
Hmm.
would prefer to see actual numbers, right? Look at the trailing 12, see what the actual income is. This is, again, a perfect world scenario, right? You've got 100% occupancy with a 3% margin in vacancy. Instead of looking at actual rental income, determining what the vacancy actually is compared to the rent roll, right? So you see a lot of people pushing this 100% rental income minus, an X on vacancy rate.
Mhm.
To me, that's just as risky in general. Every time we see this, we unravel this. Okay, what is the real vacancy? Send me the T12. Send me the
Mhm.
trailing 12 details to showcase what you really have as vacancy. So you're absolutely right. You see a 2% or 3%. We'll go ahead and underwrite that as a first step. But when we get into the meat and potatoes of this and we really determine that we're going to send this to the bank or we're actually going to go to underwriting, we need to really see T12 numbers, what the actual vacancy rate is. So absolutely 100% accurate.
Gotcha. Before we move on, I know we're using some big terms. We're talking about NOI. NOI is the net operating income after all of your expenses here, as you can see on the right column in the gray shaded right there. So that's just NOI is net operating income. And then we're throwing around T12, right? Sounds like a, Terminator term or calculator. All it
Yeah.
is trailing, expenses of 12 months. So T12. And you see T12, this means 12 months worth of the actual financials of this property, of the building.
Correct.
Okay.
And
All
that,
right.
guys, that's going to be your first step. If you get into a situation where somebody's sending you deals and you go to underwrite it, the first question you ask is, I need to see the T12 and I need to see the current rent roll as of today.
And
right?
preferably in an Excel file.
Preferably.
Gotcha.
Good point, Heather.
Yeah.
Good
that
point.
Would save
Preferably
you a
in
lot of
Excel,
time.
right? Because they'll send you screenshots, they'll send you PDFs, they'll send you everything they possibly can to avoid sending that. And if that's all they have, fine. We actually put it into our own Excel file. We'll unravel the data that they give us and
Mhm.
plug it into our own system. There you go.
Gotcha. Nice. Nice.
Yeah, so RJ, just to give you a little peek behind the curtain, we'll use this template. You see the trailing 12 at the bottom,
Mhm.
you see the rent roll, you see the pro forma. So that
Mhm.
way we can just come in here and plug and play. And a lot of times, a lot of this stuff gets ended up taken out. Uh,
Mhm.
but we do this in G Suite, and just to kind of give everyone a little tip here. You just come, make a copy, um, Catalpa T12, whatever the property is.
Mhm.
You start a new one and you just start filling in off the template.
This is great, guys. Thank you for sharing this. So now that we have the T12, we're initially looking at this and got some red flags. We're thinking that they're definitely not realistic with their expenses of 20%. So where do we go from here? What is the next step that you guys take?
Well, we actually plug everything in and we determine what our cap rate is.
Okay.
And where we go from there. Scott, if you could jump back to the
Yep.
the the number that they have. The
Yeah, the
Yeah.
NY number.
yeah.
So here's they have their NOI at 172,313, brings them to a cap rate of 638.
Yeah. So
I can plug that right in here to kind of show what it looks like and just plug and play. So I'm going to ignore all these numbers that are there for right now.
Mm-hmm.
And we're going to come back, grab the 172,313. Sorry if this is flipping back and forth. I just want to give
It's all good. No, this is all good.
All right, perfect. All right. So that's our NOI, right? So we can essentially just sit here and say cap rate equals this cell divided by 0.9. Okay, so that gives us a cap rate at an 8 cap.
Mm-hmm.
This is this divided by 0.07. There you are at a 7 cap equals this divided by 0.06. There you are at a 6 cap. And we can go all the way up and all the way down. And just to show you, this equals this 0.09. So this gives us a 9 cap. And because we are savvy investors and we want to buy at a 10 cap,
Mm-hmm.
we also want to see this divided by spot 0.1. All right. So, and then just to throw one more number out, our perfect world where we want to buy this at is going to be this divided by 0.12,
12 cap.
12 cap. That's where we want it. But that gives us, so then really quickly, once we've plugged everything in, we've done all the numbers, we can really quickly just have a little visual on here's our pricing point at a different cap rate and get a really good idea on price range.
Gotcha.
Is that helpful?
It is. And so what we're looking at, they're asking what, 2.6?
Correct.
2.699999.
And they're asking this at a 5 cap.
Yeah,
Which
so they have this at a 6.38 cap. So just to verify their math, we could say that this equals this divided by 0.0638. So they're close. They're
Yeah.
close.
So one of the things that we always look at too, okay, when we buy this, we can go back through and look at what they bought this for. I think RJ and I did that. I think they bought this for $700,000. They put a lot of money into it. Now they're selling it at 2.7. We went back and looked. Are the taxes they are showing on their OpEx, their operating expenses, adjusted for an increase in taxes when you go to buy this at 2.65 million?
Mm-hmm.
Right? That's a huge issue that we see a lot of people advertising properties at, with current taxes, but nobody's taking into consideration that your taxes are going to jump when you purchase this at 2.6, right? It's going to jump huge. So you have to take that in consideration. This particular property, I think they say with abatement.
Yes.
There is an abatement on the particular taxes. We don't know for how long. Does that abatement get adjusted when a new purchase price or if they sell the property? We don't know those details, right? We've got to dig in a little more. But I see this all the way up to $100 million deals where people and salesmen and realtors will advertise properties with a specific tax rate inside their operating expenses that is not adjusted at the sales price that they're asking. So
Yep.
it's another huge red flag you have to take into consideration.
And you just got to do some digging around, like you said, Brad. You got to call down to the county, call down to the treasurer, get some information on what it is going to happen. If it's purchased, does the abatement go away? A lot of times it doesn't, but then when does it go away? Because if you're going to buy this and it's a long-term play, you got to prep for that when the taxes aren't abated anymore and you got to pay for them. What are they going to be adjusted to? How much is it going to be? Is this property still going to cash flow? And you kind of have you need to see your projections 3 to 5 years from now, sometimes longer. And so you got to pay attention to this. That a lot of times it's like not talked about. And you got to do some more digging around, and you got to not only talk to probably this broker, but some of the other brokers in that area that's involved in multifamily.
Correct.
So now we're figuring out what they're obviously they're asking this, they're saying that they're presenting this to us with their numbers at 6.3. So is this something, and we also know that they bought it, rehabbed it, and now they're selling it basically from what we looked at is they're kind of selling this at retail in the, retail, we call it like that from the residential world. But like, how would we make money on it? How would an investor make money on this deal?
Well, here's another thing that you have to take into consideration, right? We all talk about cap rates, right?
Yeah.
And so a cap rate is before mortgage. So you're making 6.38% before your mortgage payment. So if you notice, mortgage payment is not included inside those expenses, and rightfully so. It shouldn't be, right?
A lot of times we will see that people included in their expenditures, though.
Right. Yeah. We'll see, you have to make certain adjustments, right? Sometimes they'll plug your mortgage payment inside of expenses. That's wrong. You got to pull that out to get an actual reading of what your true cap rate is. But a lot of times they'll give you a cap rate, and you have to take into consideration that cap rate is before your debt. So what are we, what are we getting debt at today? 6.5, right?
It didn't go down. Yeah.
Yeah. It's going down. I think the 5-year treasury is holding. So, we're constantly looking at those numbers, see where we'll land on a refi or a purchase. But what does that mean? I'm underwriting this at a 6.5 cap. In a perfect world scenario with 2% vacancy rate, with an OpEx at 20%, running this thing as smoothly as you could possibly ever run a multifamily deal, I'm still underwater by 0.2%.
Yeah.
Right. So this deal is priced out for a hedge fund. This deal is priced out for a debt fund. This deal is priced out for somebody that a 1031 buyer, right?
Yeah.
This deal is priced out for a cash buyer. So now if I'm paying all cash for it and I have to place capital, right? Because you look at these hedge funds and they have capital to place into deals. If they don't place their capital into deals, then their constituents and their investors are going to be upset because they're not making any money, right? They're being charged a management fee without being invested, right? So you have to look at that. These investors want returns, so they're under pressure to place capital, which is a really good solution for deals you're trying to sell, right? Maybe, if you have a deal and you get it under contract, I know, RJ, you come from the wholesaling world. There's no reason why you can't put this under contract and wholesale it to a hedge fund, right? That has to place the capital. They're under the gun to place the capital. But for us as investors, where we're going to go out and get debt, where we're going to go out and structure the deal with our investors, this cap rate is completely unrealistic.
Yeah. There's not much. Where it was a deal is where that investor had bought it for 7, did the work, and now they're on the other side of this deal where they're trying to find the buyer or whatever because they're selling it and trying to find that debt investor or whatever. So that's where the money was.
Correct. Yeah. This is, and that's typically like, this would be like going to the MLS and looking for a realtor and buying a home that's been priced for a new family or somebody that's going to live in the home, right? Versus a home that's an investment property. And so very, very similar scenario.
I would guess that this might have been their first multi-property deal because they're not understanding that as far as when they're presenting this information in their deck.
Yeah. Yeah.
So that might be a nice segue into looking at something on the opposite spectrum, which can come in from a very different presentation that has a little different process. Are you guys up for taking a look at one more?
Let's do it.
All right, cool.
Let's do it. We got time.
All right, cool. All right, so I'm going to share this. Perfect. So, like we said, things come in all forms. So this came in strictly paper scanned.
Mm.
I'm going to go down here so it doesn't show any of that. But so this came in, and now you got to kind of tilt your head because they scanned it funny. But your rent roll came in like this.
Yep.
Your P&L came in what looks like a Word doc. But again, rents collected, you look under operating expenses. This one looks a little bit closer. But we're still what? Right about 20% of the total for operating costs. So that's the same 20%, but it looks like we have some more specifics here. Maybe it gives us a little bit more. They also give us all the capital improvements that have gone in. So it shows us that they're savvy enough to understand that CapEx expenses do not go up here.
Good point, Scott, right? Because that's huge. When
Yeah.
you're taking a deal to the bank, right, and you have all of your information and you've got a really excellent T12. And I see this with investors that are going to refinance deals. I get a lot of calls from brokers and title agencies and attorneys that call me and say, Brad, this deal is not hitting DSCR, debt service coverage ratio.
Yeah.
What can we do? How can we get this to close? Right. And I go in and I start looking at income and expenses, and I see in expenses, they've got their CapEx loaded into their expenses, and they're trying to present it to a bank. Well, wait a second. CapEx are situations that occur randomly that, I see all the time. You may think, okay, well, part of my expenses is this, flood that backed up into my units and I had to spend $20,000. You may think that just because you paid it out of rental income, that it should be inside of your expense ratio. That's a one in a lifetime scenario.
Yeah.
That does not reflect the actual performance of the property. And here you are plugging that into your expense ratio. So a huge issue is that, when you're going to refinance these deals or you're going to look at these deals to take them to the bank, you need to make sure that your CapEx is separated from your actual monthly expenses.
Gotcha. Good point, Brad. And that's something that, that's really from doing this so many years, no one would really know that unless you're actually doing this every day to really determine that. That's an experience thing.
100%. And the only reason I know it is because I've been denied, right, from the bank because I'm, it's like it's in the trenches type knowledge, right?
Yeah.
So 100%.
All right. So you see profit before depreciation and debt service, which is essentially their NOI, right below 170. And then this, we kind of got to tilt our head again to look at it. I almost turned my computer thinking that would turn the screen. But so you see it's monthly. So December of, I'm going to make this a little bit bigger. So December of 24, November of 24, October, September, August. So it gives you all that information month over month. So that's the T12.
Yeah.
You got to kind of lay on your side to see it. But it demonstrates two things. One, it demonstrates that things come in different forms, and it shows how savvy of a seller you're dealing with, if that makes sense.
Yeah. Yeah.
All right. So, with this NOI at a 169 cap rate, we can come back here. 169, what was it? 030, I think. 080. Okay, and it automatically adjusts all that. So we can see what's a good deal at a 12 cap, at a 10 cap, at a 9 cap. So we can look at this, and now this particular property is actually priced below a 10 cap.
Hmm.
So this is one that we look at and say, these people have their stuff together. They're priced at a place where we can make money and cash flow it. And this is where we would immediately start digging into how much debt, what are you willing to carry? Are you willing to play ball in our structure? Are you willing to structure the deal the way we want to? And that's when we start asking those questions.
Can you share that? Can you share that that template for this particular property, Scott?
Yes.
Yeah, I think you're on a different screen. You just gotta
Yeah.
go to that screen when you share, but
There we
you
go.
Oh, okay. I'm sorry. Yeah.
No worries.
So here is the NOI, the 169.
Mhm.
Here is where it would have been priced if they priced it like the other company at 2.8.
Yep.
This is where we're actually priced on this particular deal. So you can see the difference in the first one from possibility jumps off the page.
Gotcha. All right. So different deal, different numbers, but this one seems to be within range for us to make an offer, you would say.
Correct.
And
Got
we're
it.
actually looking for capital partners on this deal. We're actually looking for potential private debt on this deal. So this is something that we're engaged in. There is a creative finance component to that. That's what we specialize in, is creative finance deals. So there's a creative finance component to this. They're carrying some deals. So I know you've got a pretty good following. If you've got any investors out there that are willing to look at this, and
Yeah.
we would be happy to discuss that. It's one of the reasons we put this deal on the page, is because this is a viable option, right? We're under
Like
contract.
this is an active deal right
This is an
now.
active deal.
So RJ, this is a deal that I could put under contract right now. And if we brought in the investor to cover the gap, either through debt or through equity, it would immediately cash flow today.
Correct.
That's awesome. That's awesome. Let me ask you some questions real quick before we move on.
Yes.
I am going to get your guys' info so that I can put it in this video training link. We've got some questions. There's some people that want to see this training. So I want to make sure we get that as well. But so when you're choosing a market, so is this deal in Ohio?
Yes.
Okay. So talk about how you go about even choosing a market to do these type of deals, these multifamily deals. Like, what are you looking for? Because there's some people that are watching this now, and I'm like, I wonder if these are deals that I can do in my own backyard. They could be somewhere in
I'll let Brad's
California.
20 years of experience speak to that.
Well, we're looking for cash flow, right? Cash flow is king. Can it cash flow? You look at areas, Florida, you look at areas, California, New York, right? These outlying states, they're selling it, 3 caps.
Yeah, and not to mention, they're not very landlord friendly. There are not great laws in place to protect the landlord from tenants and things like that. So we tend to not look in those areas.
Correct. So 100%. Yeah, that was going to be my next point, right? Is it landlord friendly? If I have to do an eviction, how quick can I get these people out? And then, then you're diving into, and I guess this is more on the underwriting side, but what are the properties selling at cap rate wise, right? So we talk about certain areas where the cap rate isn't going to hit our debt mark, right? Where we're California, New York, Florida, where they're selling at 5 caps and our debt is at 6, we're already underwater, right? In these, we like to call them the Rust Belts, these Midwest areas, everything, Indiana, that you really have strong cap rates in these particular areas. 10 years ago, I was buying at 20 cap, right?
And there's typically double-digit numbers here in the Midwest.
I haven't seen that in a long time.
Yeah.
But how do you go about determining that? Like, where is that information available? Is it through phone calls to brokers? Is it on, is there somewhere that one could kind of go in and find that out? Like because what you're saying is, and there's a lot of similarities between multifamily and residential from a standpoint of like, choosing an area that will cash flow, landlord friendly state, But from a cap rate standpoint, where does one go to find that information?
Well, you can ask brokers what are they selling at? What is the cap rate here, right? I like to look at that on the refi. When I take this to a bank, or when I even on a purchase, when I take this to a bank, what are they going to underwrite this deal at, right? And I'm seeing, that's going to be specific to a mortgage broker, a realtor that's constantly doing deals. But if I'm engaging and just kind of looking at the market, you can go on anywhere and define and determine what is it renting for, what's the rent renting for, what's the rent for a 2-bedroom, and what is the purchase price, right? And is that the 1% rule, 2% rule, right? Does it rent for at least 1% of my asking price?
And you can just multiply your, projected number from that rental price, your typical vacancy rate in that area, and, add up your projected T12 without even getting any of these numbers, and then just divide by 45.45 to get your operating expense, and then kind of create your own cap rate to see.
Correct. Yeah. We've been doing this a long time, so we can immediately engage, right? You're looking at purchase price versus total units available for rent. Right? Let's say you're looking at an 8-plex and they're all 2-bedrooms. Well, reverse engineer. What is one 2-bedroom rent for in the area? Is it 800? Is it 1200? Well, just multiply it out. Now you've got 8, right? Does that equate to a purchase price? The 1% rule, the 2% rule, where are we in the spectrum?
You have to do your due diligence.
Go ahead, Ashley.
I was just saying you have to do your due diligence on it.
Correct.
Yeah. I think RJ specifically, there's lots of sites and lists and places where you can find information about multifamily. I don't know how much detail we want to go into about, what sites to use and what companies. There's tons of websites and places that will give you this information. I think the key is understanding the key metrics that you're looking for in terms of price per unit, in terms of initial cap rate, in terms of price per unit based on the area. So like Brad said, there's some things that we use to do really quick calculations to see if it's even in the ballpark of being a good deal. And then as you kind of get yeses and green flags, you keep going deeper and deeper and deeper. And kind of like on the Catalpa deal, we kept going deeper and deeper and deeper, and it kept giving us green, green, green. And now we're at a place where we're like, okay, if we can get someone else in here, this is a done deal.
Yeah.
Whereas on the first one, we went deeper and deeper and deeper and went, I don't know. I don't know if there's a path here.
Yeah. Gotcha.
Is that helpful?
Yeah. Yeah, it is. So, I mean, a lot can be done when you pick up the phone and talk to some mortgage brokers and broker that. I mean, that deal with commercial, and then also there's nationwide lenders that do these all the time, and you can pick up the phone and call them, and so they know because they're involved in the refinances, because a lot of investors are doing that. Is they're buying it, private capital, or doing a money raise and creating a PPM to do this, and then investors got to get paid back, so then they got to go and do the refinance. And so a lot of the nationwide lenders, and then also some of the local banks, it's where you can go to get what multifamily is trading for in that particular area. So okay, so now you're going to make the offer, and because it sounds like it's passing all the initial tests. Once you make the offer, are you now going to, and I'm just getting into some of the nitty gritty on multifamily deals, but do you go to the site, check everything out, right?
Yep.
That's the next step, is do a
Yep.
site
So
visit.
Catalpa was green flags. So we did a walkthrough, saw the units, saw the property, gauged renovations, gauged immediate cash flow, gauged how turnkey is it really.
Yeah.
Did all of that, and then sent the offer.
Gotcha.
Also too, what is the upside, right? Is this completely turnkey? Do you have room for rent raises? Do you have room for rent raises that are realistic, right? Are you going to raise the rent to max and then have everybody move out? Right. What is the ability to raise rents in a respectable manner to continue to maintain your tenants and continue to cash flow this thing
Because
forever.
we're always looking for value add, and when you're operating at about 25% rate there
OpEx.
of OpEx, yeah. So we're going to need to increase probably rents. We can't really cut expenses too much.
Gotcha. Got it.
And luckily on that particular property, we found that almost every unit was considerably below market and that we could do a relatively insignificant rent raise. And on 22 units, $100 a door is, about at a 10 cap, it's about $250,000 that you just created by $100 rent raise.
So now leads me to my question: what's the main difference between single family and multifamily underwriting? Is, with residential, right? You're going off of what other properties are selling for in the area.
Yes.
Versus a multifamily, it's all about getting this building, unit, whatever, getting it performing at max rents because it's all about how it's operating. It's all about the operating net operating expenses or net operating income,
Correct.
NOI. And so that's the beauty of this, because you kind of have control over that,
100%.
right?
Right. That's why we specialize in multifamily, because we can force appreciation. We can create our own value. Whereas, you're dealing with single family 1 to 4 units, your value really is capped at your neighbors, right?
Yeah.
What is it that you're going to be able to get out of this? So we focus on multifamily, the larger the better. And we like to be in a position where we can do a rent raise and see exponential value immediately. We also look at expenses. Are these expenses too high? Can we come in and take over management and drop that expense ratio, and then also increase our NOI? So we're constantly looking at both sides of the coin. What are the expenses? Is it being properly managed? And what are the rents? How far can we push them and how far we can raise them, and still keep our tenants there and happy and content, right? Because when multifamily, right, you have a tenant that feels like they've been taken advantage of, you have a problem, right? So we're always looking at that side of the, I see a lot of guys come in, I can raise it, $300 a unit. Yes. How fast can you do it?
Yeah.
And should you do it? And is that the right thing to do, right? Having a socially conscious view is super important too, right?
Well, and if you're in a state that allows, allows you to raise rents. Yeah.
Yeah, because we're seeing more and more. We're seeing more and more with caps on rent raises. So that's a huge, huge question. That's why we love the Midwest, because
it's another reason we stay out of California.
Yeah, we're not buying in New York anytime soon, are we?
No, probably not.
Our mortgage broker won't even look at anything if we ever give her anything from New York.
No.
Brad and team, this has been a really, really exceptional training, and I want to make sure that if you're watching this, you guys can connect with Brad and his team at Midwest Acquisitions. If you are an investor and you want to get involved in that deal that he presented, it's a live deal. It's a deal happening today that you guys can get involved in. What is the best way to connect with you, Brad, and your team?
Yeah, we've got our website, midwestacquisition.com, no S on the end. Ashley, Scott, Heather, and myself are there. You can shoot an email to info@midwestacquisition.com. We also have a company called Affiliated Capital Group, which it's a debt fund that we're actively engaged in finding investors to place capital so we can then go buy properties and lend to other real estate professionals. So we're actively engaged in that. And my wife is also, she's formerly a nurse, and she's got a social media presence called, well, you tell them.
It's RN, like registered nurse, the number 2, RE for real estate investor. So RN2RE investor.
And is that Instagram?
I think I have, I don't know if I have it connected
Instagram and TikTok.
It is definitely on TikTok, and I believe the same username is on Instagram. And it's new. I have other social media accounts. So I'm just starting to build that, but that's where I'm going to be putting most of my information.
So little side thing. I retired my wife from healthcare, right? And so we're doing this. We're totally all in on real estate, and that was a huge milestone for me. And so Heather, I couldn't have done it without her. And at this point, we're looking at healthcare is a rough business, right? A lot of hours in there, and is it really worth it when you can create a lifestyle like this through multifamily? So I'm all in on multifamily. And RJ, you and I have done some crazy deals together. We've been we'll talk about in the trenches, man. We've been through it. 500 units.
Yeah,
So
crazy.
we've done some cool
Lots.
stuff. So
Yeah, I'm interested in this deal as well, and we are also looking for deals like this to do with Brad and his team. So if you guys have deals, if you want to partner on the money side of the deal, I put Brad's info. Definitely follow at RN2 RE Investor in there, or it's RN the number 2 RE Investor, and they're on TikTok and Instagram. And if there's any other questions, let me see. So somebody wants to see if they can get that spreadsheet. I don't know if that's something that you want to
man, I don't
share,
know. That's
but
the secret
why don't
sauce.
you why don't you share? So why don't first off connect with Brad and his team, ask them directly. Maybe there's some synergy there. And then another question is, where can I get a link to this training? So this is going to be, it's being recorded. It's going to be on YouTube. And we can certainly send you the link with Brad and team's permission.
Yeah.
So connect with us there. You've got Brad. Let me make sure I got the right email. So it's brad@midwestacquisition.com.
Yeah.
Okay.
And
So I
then
think it's
Scott too. Scott, Ashley, Heather at midwestacquisition.com.
First name. And
Yep.
if there's enough interest, we have an office building right outside of Dayton, Ohio. And if there's enough local interest, maybe we have a class or something in person, so you can ask.
Yes, I like that idea.
We've talked about that with RJ a few times. I would love to do a meetup. And if you guys reach out to us, you want to see that spreadsheet, we'd be happy to share it with you. There's no gatekeeping here. There's no nothing we can't provide. So I'm 100% on board with that.
That's awesome. Well, guys, thank you, and gals, thank you for this time. I think there was a lot of value shared here. Please connect with Brad and his team if you're interested in that deal to be on the money side. And if you see a lot of value in this, make sure you comment, subscribe, share this with somebody that's looking to get into multifamily. I think we covered a lot on here, and we'll probably be doing this. I don't know. Maybe we'll do this again. I don't know.
I'd love that.
They're busy, but I was able to get them on today. But we might. So I'm going to talk to Brad and see, because I know Brad's taking a look. This isn't the only deal that he's looking at. Doing a lot of deals in the multifamily space. But if we can do this again, we'll let you know. And if you have any questions, if you're seeing this after the fact, put it in the comments and we'll get to your questions. So thanks for being here. It was good to see you, Brad, Scott, Ashley, and Heather.
Likewise.
See you on the next
RJ, thank you so
live
much.
stream.